Yeah, thanks everyone for coming today. Appreciate it. Hopefully, keen to make this an interactive conversation today. So we've got quite a lot of time at the end of the slides, each section of slides for some conversation. You've heard a little bit about me. Just to very quickly talk about Accelerated Digital Ventures and introduce us as well. We are a patient venture capital investment platform. Hopefully some of those words will make a bit more sense by the end of the session today. But what that means very quickly is that we invest in early stage, so from seed to Series A, digital tech businesses, and we do that for the long term. We look to invest in businesses that have got and are on long, high growth, scale big growth trajectories. We invest through a platform, which means we try to make this a quick and efficient process based on a technology platform that's helping us build out also a strong picture of what the tech ecosystem looks like across all of the UK. And we're doing that because we're invested by a group of institutional investors who want to support and create a pathway through us and through others for founders in the UK to go and build really big, scale big businesses and not have to look to sell their businesses very early in the growth of their business because of the nature of the capital that they've taken, and support them through to the large institutional investment rounds that our investors want to participate in to give founders the chance of growing some really big businesses here in the UK. We're a team of, not a typical team of investors. We're built by some former entrepreneurs and operators of businesses and ecosystem players. And what we are trying to do, we recognise that there's a real challenge when you're a founder starting on your journey of building and looking to kind of realise the vision that you have and build the biggest thing that you want to build out of the vision that you have for a new business. And we recognise a real challenge around founders from wherever they are across the UK accessing the right types of investors that can help and support them and build partnerships to go along that journey. So we're building something called the Venture Marketplace, venturemarket.org. Worth you having a look at some point. It's a marketplace where tech founders can surface their proposition for a whole bunch of tech investors. There's 10 or so venture capital firms on there just now who are mostly all based in London, but it means if you're a founder in Newcastle or Glasgow or Manchester or wherever you might be, you can immediately access these 10 VCs, which would otherwise have been really challenging to get there. And it's to start to help create a much more efficient way of finding the right match between founders and investors for the journey that founders want to go on, and that's really the theme of today's conversation. So today's about raising equity funds when you're and starting to address that when you're at the very early stages as a founder of building and growing a new business. And we think there's a really fundamental set of and level of thought that you need to have when you're starting that journey and thinking about investment. There's like a level above that. You really need to think and understand the journey that you want to go on as a founder. What's the long-term vision you have, and what do you want to build in that long-term vision? And a lot of that is about who you are as a person and who you are as an entrepreneur and the type of challenges and problems that you're facing. But what's your long-term vision for what you want to build? And really always have that as your North Star point. Keep that in mind at all times, because that's what you're then doing is beyond that is actually understanding and mapping out the journey and the resources that you'll need to follow and the resources that you'll need to co-opt and bring into your business to support you through to that big vision. A lot of that's people. Who are the people you have right now around you? Who are your co-founders or who are in your team, and who you'll need to bring into your team over time? What's the type of mentorship and support and advice and network you need around that? You need to be thinking about the technology stack you'll need to build. You need to think about the networks you need to build, and all of that is then once you've mapped out what you think that journey looks like, then you start thinking about what financial resources and what capital resources you'll need to establish to help you build those different resources. And some of those things can then be funded in other means. It might not necessarily be that you need to go and raise investment capital, but you can go and raise grants, win grants or win competitions in the very early stages to support you through building these resources up to keep you going towards this long-term vision. And once you've done that, you can start to establish what that vision is and what that vision will need and how you can build that up over time. Then you can start to identify, actually, that is something that's going to need equity investment. I'm going to have to go and raise capital because at certain points in this journey, I'm going to need external capital to allow me to do these things, to propel the business forward. And you can start to understand the type and scale of investment that you need, and all of that as a means of getting towards this long-term vision and what the scale and the size of that long-term vision looks like. And then you can start to identify, well, one, yes, I do need investment. Two, am I building the type of business that can raise that type of investment? Product businesses can raise equity capital. That's the type of, if you're a services business, that tends to be a more challenging business model to raise equity investment upon, because you are because of the way in which value is built in that type of business. And what kind of scale are you going to need? What level of resources are you going to need to build, and at what stage ultimately to lead you to what type and size of ultimate long-term vision are you going to be able to build out of all of that? It's really about understanding you and your vision in the first place, and what you're going to need to get there. I just wanted to clarify, just so we all understand what we're talking about by equity investment. It's sometimes not always absolutely understood. When a company's raising equity investment, what it's doing there is it's raising money from an investor who's buying a share, who's buying a proportion of the company, and providing capital, providing money to the founders to go and spend that on building the future, building the next phase of that company's journey. It sounds really transactional, therefore, I think when you put it in those terms, and there is a transaction happening there, and I used to be a lawyer, and don't hold that against me. That was what we were doing. We were helping people execute that transaction in the most efficient way possible. I'm not sure all my ex-clients would have said that, but anyway, that's what we were trying to do. But I think that's really a very narrow way to look at it, and it's a very narrow way to think about equity investment. And I think equity investment works best and works most optimally as a relationship, ultimately, for founders and the companies that they're building and the investors that are investing. If you think about it much more so as a partnership that you're building with investors. So it's less transactional, and it's much more about partnership and support and trying to align on that vision. And I think for you to do that as a founder, you really need to know and understand investors' business models as well, because what you're really trying to do is match your vision and your journey with an investor's appetite and model and thesis and strategy for investing in those types of journeys. And there's really understanding, therefore, how your opportunity as investment fits into their model, and how vice versa, your opportunity and investment fits into the investor's model. Where I think there are a range of commonalities between investors. There are different types of investors, as you'll all have heard the terms, and we'll talk about them in a second: angels and VCs and patient capital investors. What they're all doing in common is looking to ultimately seek a return for the capital they're investing, that's from the growth that's fueled by their funding. They also differ, however, and I think, again, this is part of this kind of planning and understanding the investor business model. They're all quite different in terms of their appetite for risk in some cases, their scale, the scale of investment that they can deploy, the timing at which they look to deploy and seek returns on that capital. There's quite a significant degree of variance in those aspects. Some are also structured differently. That drives their behaviours. Some are structured in order to get tax incentives. So lots of angel activity is very much driven by the tax reliefs that go along with investing in early stage companies, that the government Treasury want to incentivise individuals to support early stage businesses, and that then drives some of the behaviour, their capacity to follow on and do later stage, next stage investments to support you through to the next round of investment. There's lots of differences, so it's really, it would take more than 2 25-minute sessions to really talk about these in detail. But what I do want to flag is it's worth really trying to understand the differences in the different types of equity investor, and I'll try to give you a broad understanding today of that. Angel investors, easy to represent with an angel symbol. They tend to be individuals. Angel investment can be kind of coalesced in funds as well, in enterprise investment scheme funds, which is this form of tax relief. But it tends to be individuals' cash who are investing relatively small checks in the order of tens to hundreds of thousands at very early stages in companies. And the earlier the stage, the higher the risk, the greater the tax incentive there is for angel investors to invest. So they invest at pre-seed and seed stages, and they tend to want to be quite hands-on and supportive because they tend to be entrepreneurs themselves. They may have raised cash, they may have made their own cash through exiting businesses themselves. What's great these days is that there's a big growing cohort here in the Northwest, equally in Edinburgh, also in Bristol, of angels who have made their money in tech businesses, and this place is an example of angel and of a tech entrepreneur who've made capital and are recycling that capital into tech businesses, and they can bring a lot of learning. I think there's a much more traditional cohort of angel investors out there who to date have not made their cash in tech businesses, and for much more traditional businesses who don't necessarily understand the life cycle and the challenges and the demands and also the opportunities of how to build a tech business. And I think that, again, tech founders need to be very thoughtful about the nature of the angel investor and where they have made their money and the understanding that they have of the type of business that they're investing in, because angels do tend to be quite engaged with their businesses because quite often they're so early stage, the founders are seeking and needing quite a lot of support at that phase. And there are some angel investors who are keen to support their founders and the companies that they invest in and support them through to the next stages of investment. There are angels out there around the country who take a different approach and who want to solely found companies in and of themselves from the capital that they can bring to the table, either from their own pockets or from syndicates of angels. There's quite a few syndicate groups of angels as well. They tend to coalesce in order to increase their firepower and mitigate their risk. Angels will often group together in angel syndicates and invest, and sometimes that's informal, sometimes it's quite formal. And some of those are very keen to support businesses through to later and next stages of investment. Some are very keen to invest in companies and be the kind of probably the sole investor for that company. And it's understanding the strategy of your angel investor is very important. And indeed, founders, any of the comments, founders should really feel, and I think good enlightened investors are keen to see and welcome being challenged by founders on what their investment strategy is and how they want to participate and support and be active in businesses and support businesses through to next stages of investment. And it's very hard to find some of that out unless you actually just ask an investor up front in the conversations you're having with them. Venture capital investors invest at the next stage of investment. They are funded by institutions. They've gone out and raised money in the financial markets and invest at the next stage. So angels tend to have the highest risk appetite. VCs are still investing at kind of seed through to Series A, so slightly later in the cycle, so slightly de-risked propositions. But the real structural difference there is that, as you were saying, these are fund managers who have raised capital from a group of called limited partners, and it's been placed in a special vehicle that has a particular defined, at the start of the process, has a defined life cycle to that, a fund life cycle. And the deal is the VC fund manager has raised capital in the markets, and it's very much a capital transaction between them and their investors, taking the capital from these parties, put it into companies to return that capital at the end of that defined fund period, and that's usually 10 years. And therefore, they're very much focused on investing in companies that they can see that there's a kind of liquidity point within that fund period that they can, which generally means actually we can invest now in years, somewhere between year 1 to 5 of our fund, and then the way the funds are structured, we've then got another 5 years to try and support these companies through to those companies being exited, i.e. probably sold, and then we can see a return on our capital. And we aggregate that across a portfolio of investments, so depending on the size of fund and the investment strategy, VCs will build up a very defined portfolio. It tends to be focused around a certain stage of investment so they can see a proximity and a way of supporting companies to those exits. exit points. VCs tend to have some element of exited tech entrepreneur within their team, and so they focus on the sectors or the segments around which they've been successful before. So they're very focused around investing at a certain stage, investing in certain sectors because they've got experience and skills and network that they can support those companies to get to that exit point within the fund period. What they are looking for, therefore, is big outcomes, because in order to return the level of capital that they have promised their investors, every time they invest, they're modelling that the investment that they're making at that point in time can make something like somewhere between 30 to 40 times their original investment, because they invest over, if it's 20 companies, they probably model that 2 to 3, maybe 4 of them will be big outcomes. The rest will fail or return very little on the original investment, if anything. And it's that level of return that then helps to deliver on a portfolio basis the level of return that they have sought to, that they have originally raised their pot of cash on in the first place, and they have to return that at the end of the 10-year period. So they're very much focused on stages, on types of company, and on supporting companies through to a certain point in the growth cycle of a company. And so it means they're probably looking to sell a company within 5, 6, 7 years of the point at which they invest. And again, you as a founder need to be on that type of journey and want to be matching that's the type of outcome that you're looking to get. What that generally means is that those businesses are being sold when they are medium-sized businesses, medium to large, but on a certain point in the growth cycle, where there's still quite a degree of growth to go in the opportunity, but that growth is exploited or is executed by whoever's bought the business at that point in time. Patient capital or patient venture capital is the next, and is a kind of relatively new model but growing model where it's venture capital still investing in technology businesses at all stages from seed up through to Series A and on. But we're fortunate that we've got more flexibility, and we're with ADVs in this model. We're not structured as a fund with a fixed life, so we're able to support companies on a much more long-term patient basis. We're not driven to look to see companies' value be realised at a certain point in time to create a cash exit and a return. Our investors actually are investing for us to help be a kind of an opportunity pipeline for them that we'll support businesses through to beyond those traditional VC exit points or angel exit points, and be raising capital in the way that the Hut Group, for instance, in the Northwest, or the Skyscanner in Edinburgh was doing in the last 10 years in these very high scaling, much later rounds of investment, and giving founders that long-term and long runway to go and build a big business, rather than see it bought by a large corporate and absorbed by them at an earlier stage. And so it's really important to think about the right partners for the stage of your journey that you're on, and how you align to their strategies, and whether the investors that you're investors who want to take you to the exit point that you want to, or whether they're investors who want to support you onto the next stage of the journey that you want to go on. I think what's quite important too is just understanding how you position a proposition with an investor. So very much, there are 2 points here I want to make. You really need to understand that there's this partnership process that you're going into, really, that you're not. If it's done at its best, it's really about building a relationship and a long-term relationship and partnership with investors. Not to say there's a whole bunch of investment that goes on out there that is much more transactional, and sometimes that can be a means to an end, and sometimes it's a way of actually leveraging the good relationship building investment that you want to do. But if you're raising a round of investment as a founder, with your lead investor, whoever is leading that round and being the primary investor in your investment round, I think that it's really important, if you can, to be building a partnership with them for the long term, whatever that means between you, in terms of the match, in terms of the alignment that you and they have together. What's really important too, as I've seen over lots of years, is that when you're a founder engaging with investors, you're engaging them with an investment opportunity. You're not engaging them on the product itself. So very often we'll see and we see it still today, we've seen it in the past, pitches, founders going to investors and pitching them the product and forgetting, because you've been so involved and so ingrained in building the product and living and breathing that and engaging your market with it and testing and validating it, that actually the conversation with investors is a different one. They're not customers for your product. They're, in a sense, a customer for the investment opportunity that you're presenting. And it sounds really obvious, but it's an easy one. It's an easy one to miss quite often, or it's an easy track to find yourself going down, is actually selling investors the product rather than, in a sense, the partnership opportunity, the investment opportunity that they're looking to engage in. They obviously want to know about the product, they want to know about the team, they want to know about the opportunity. All of that stuff is important, but it's really important to remember that it's not the product that you're selling them. And this is the kind of key point of this section, is it's about demonstrating that alignment. So having understood investors' business models, talk a bit more in the second section about going out and really kind of identifying the right investor for you. But when you're positioning your it's about aligning your vision and the journey you want to go on with the investor's investment strategy and thesis in their model. It's about showing that there's a really good match between the journey that you're wanting to go on and the journey that they like to go on with founders, and that the two things are parallel to each other and actually will create a good match. That doesn't always necessarily mean that it's about creating a journey that will take them all the way to that end point. You can find alignment with investors who can see that actually they're investors who can support you to a certain stage in your journey, and then hand it over to other investors, and that might mean them seeing some return at their point. But it's really demonstrating that there's a really strong and good match between the vision that you have and the visions that they like to back. And I think that's really important. And so really understanding the investor's business model that you're addressing is really key, or the class of investors that you want to talk to. I think too, what's quite important is understanding why you raise investment in the first place. It sounds a really kind of obvious point, but it's really fundamental. When you're raising investment, to go back to that earlier point, investors are acquiring a share in the company. So by definition, you as the founder, you will have less of the company. You will have a smaller percentage and proportion of the company than you did the day after you take investment than the day before. So you as the founder are going to, and we talk about this a bit more, you're going to be seeing some dilution of your equity when you take investment in. So what you really need to be doing to build that, to use when you take that equity in, is to build value, both for you and the new investors in the company from that equity capital that's coming in. And that's across milestones that you can see when you're planning to raise a round of investment. When I raise this round, it's going to take me to a set of milestones that, relative to where I am today, in terms of deploying this capital on the plan that I've planned out, to acquire the resources, whatever that means, to go and do the things I need to do, that I'm going to take the business that I'm building from this valuation point to this valuation point, and we're all going to benefit. People who are all in the business here are going to benefit from how we've deployed this capital and the growth that we've ultimately fueled in that phase by achieving these milestones. And if the answer is at any point when you're raising external capital is that you can't see that there's an obvious step from here to here, then you need to think again about whether raising equity investment's the right thing to be doing, and whether you should be doing something else at that point in time. That might be raising grant funding, or finding a way of generating revenue, or whatever it might be. But if equity isn't there isn't a clear, good, strong set out plan that you'll go from here to here by way of valuation, it's not worth you as founders suffering the dilution in the first place to go and do that. And it sounds obvious, but it's really important. And that's also what the investors are looking for, that they can see that by deploying this capital, you're going to be able to move the business forward. Another factor that's really important is that, and I with this accent you can tell I've grown up in the Scottish market, which is kind of has a degree of remoteness from some of what's going on, and we see lots of times there's great celebration around raising capital, around founders raising investment, And I think it is something to be celebrated up to a very limited point. It's only a means to an end. It's a means of enabling the company to grow and to go and build that value. I think in lots of, and not just in the UK, all over, there's a great celebration of raising capital, and it's always newsworthy, and it makes the press. What I think is really disappointing is what you don't see very much of is that tech startup or that tech scale up saying 3 or 6 months later, actually, the outcome of raising that capital is we've now won this enormous contract, or we've got these million new users, or it's just a means to an end, and there's a bit of a, and I've seen founders in this cycle. There's a bit of a risk that funding, particularly as the founder, when you're there to drive the business forward, that the business or it feels like the business model has actually become about raising funding rather than actually going out there, engaging in the market and deploying your product in the market and finding product market fit and finding a scalable sales model that you can go and build your business on. So just remember too that investment is a means to an end. It's not an end in and of itself. And sometimes, depending on how much capital you're able to raise, it's quite a hard cycle to get out of, because you never quite raise enough to get out of to be able to put the fundraising toolkit down and work on the business, and then go back and pick the fundraising toolkit back up again to go and raise capital at the next stage. So it's, as founders, it's really important to remember that this is just a means to an end about getting you ultimately into the market, and ultimately finding that scalable model that you can go and really ramp up and build at pace, that increase in value for yourselves fundamentally, and it's really important. We've seen investment over the years become a very investor-centric activity. It feels like it's all about the investors. It's all about what the investors are getting out of it, and we're very keen that founders kind of take ownership and are able to take ownership of that investment conversation and process. So bear in mind, it's ultimately, you guys are the most important people in a company, and it's about building value for yourselves as well. So it needs to be an investment relationship and an investment dynamic that allows you to build value for you and not just for the customers. For the investors, there's the sad story of FanDuel, which you might have read recently, where ultimately it's been sold for $400 or $500 million over in the US, an Edinburgh startup online fantasy sports platform that has been sold, and the founders, it raised over $500 million. It's been sold for just over $500 million, but the founders have seen nothing out of the exit because of the way the investment's been structured, and the investors have stacked all the value to them first. And so when this business is still sold at a decent level with a degree of return, it's not distributed over all the founders. It's a cycle that's hard to get out of, but we're really keen to see, and I think founders should really come to this process making sure that it's at its healthiest when the value building is reciprocal for each of the founders and the investors. And think of investors too as this part of this partnership. They're coming onto your team, and as being part of your team, they should be challenging your vision and ambition at each point. Every time you're engaging with investors, seek feedback from them, and the type and the nature of feedback that you get will tell you a lot about whether they might be the right partners for you. So ask them for challenge. Ask them to prod and probe your thinking and your vision, your proposition, and how and the plan of how you're going to get there, and seek that feedback. And as much as anything, you will learn a lot about whether this is the right partner for you, and whether they're doing that in a constructive and supportive way to try and help you build a bigger vision. Take constraints, take the blinkers off your eyes, or actually challenging you positively to think bigger and go bigger, because they can see a bigger opportunity that you might not be able to see, or whether they're really challenging in a way that they would be trying to drive you to a point which is perhaps not the point in the level of business that you want to build. And just be aware, different investors will have different impacts upon your business, and could ultimately be quite influential on where you end up. There's a wee example there of the founder who who has a certain set of skills gaps in his team and his proposition, but he or she wants to get to a particular place, and they've got a certain resource that they're looking for. This matching is really important to help you to get to the next phase. So yeah, investor B in the middle there is clearly the right one for them. But if you were to go with the wrong investor, it can really heavily impact upon how quickly. Quite often, it's not about whether you get there, but the velocity at which you get there. And as founders building tech businesses, speed and velocity tends to be as important as any factor in the business. So it's also thinking about which investors can help get you with really charge your progression towards that next phase. So that was all I really wanted to say in this first section around understanding your own vision and being able to really think about your own vision and what that looks like and what you'll need to get there, and about then understanding investor business models and thinking about where you can find a match between those two things. In this section, I want to help you think a bit more practically about that first section being really focused on this concept of building a partnership, and that needs to be based on understanding the landscape, and you're part of that landscape, so understanding your own model, who you are, where you're trying to get to, what's your vision, having a sense of your vision, and then finding an investor who's aligned to that, because that's the type of vision that they want to back and support, or that's the journey they want, or along that journey, that's the type of journey that they want to support, whether they go with you all the way, but then they're up for being on that nature of journey. I want to think about a few more practical things that might help you as you're going out to start building an investment proposition and engaging investors in the market. Some of this kind of gone over in concept, but just to give a bit more detail. I mean, what you've hopefully got out of that is founders, will, and sometimes they come from the market that they are looking to engage in and take a product into, but really think about researching your investors as another type of customer market. It's a different proposition, but understand them, and it's actually I think that's quite a hard thing to do, and it's not quite as interesting and exciting a thing to do as understanding the customer and the market dynamics of your customer market, but if not to quite the same extent, but really do research and understand the investor as ultimately a customer for as you would as a customer for your product. This screen is flashing up and down a bit in front of me. If that can be fixed, that would be great. And then why might a particular investor be the right partner for you? Again, this is a bit more, so just to go into that next level of research around understanding, am I an angel capital investment proposition? Am I for venture capital? Am I for patient venture? What link to the vision that you're on? Within those, it's the question you're asking, within those different types of investors, there are the different segments of investors, there are different types who will focus on different types of investments, be it sectorally, might be a stage, might be a size thing, but actually look at investors and look at the deals, look at the investments they've made, and think about how you might fit in alongside those investments. So do research their investment strategies and thesis, think about their model, think about the stage of investment they like investing at. If you're exactly like something that's already in their portfolio, they're probably unlikely to want to invest in a Me Too type product, even if you're a million times better, there's a challenge there for them to go and take that same type of risk again in that same. So maybe don't prioritize that investor, but prioritize the guys who you can see have invested in the other two bits of the supply chain that you sit in. Think about where you might fit in an investor's portfolio, and there's really good tools out there actually that you can go and are accessible at certain levels anyway to everyone. Crunchbase, Bowhurst, data businesses, TechCrunch, think about they're quite good database search tools that you can go out and access, and you can find out exactly what investors have been doing, who's been investing in what. I said before, what's key is understanding. And what I'm not giving you today is here's a template for raising equity investment. So hopefully, messages that's quite different for every founder. It's different, and across different types of business models, it's quite different. But what tends to have a bit of consistency in it is the steps of the investment journey. Do understand there are different phases of the engagement. I'm going to talk particularly a wee bit more detail about for I think investors at this stage of, as I understand, at this stage of at this stage of your journey. Socialising your opportunity is really important. But again, there's an element here of this is similar to a marketing and sales process. You are marketing an investment opportunity, and then you're looking to execute that investment opportunity as you would in the sales process. So you do need to think about building a funnel, building a pipe, building up the top end of that funnel, creating a pipeline of interested investors, and then finding the right lead one for you. And as I was saying earlier, you will, in most cases, investment rounds are made up of a group of investors. It's rare that anyone goes and raises, particularly the larger rounds, just £5 million from one party. It tends to be from a syndicate or a group of parties, but they tend to be led by, and you hear this founders get this horrible response from lots of investors, and that they're interested in investing, but not until you can tell us who your lead investor is, and this is this real key challenge, and indeed there's lots of followers out there, but there's not many leaders. But I think you can optimize finding leaders if you do that exercise I talked about at the start, and really understanding who you would be a great match for. And part of doing that is socializing your opportunity before you're even ready to start raising, going out and really understanding and engaging in the investor market and start building some relationships with them before you're investing, or one round ahead. Going and talking to your Series A type investors when you're at the seed stage or whatever it might be, and then there's the more kind of functional points when you get to the kind of execution phase where you've found your lead investor. A syndicate has coalesced around them, or some of the interested investors who you've had, and start getting a lot more engaged because you have found someone who's a lead investor who tends to be of the nature of who we talked about. They have particular expertise in the sector that you're in. They can, other investors can see, can take comfort that if they're up for investing in this proposition, it's de-risked by that particular type of engagement, both now and in the future, because of what that investor can bring and support the founders by, and therefore, some more passive money that's less specialised can come in along beside it to fill out the funding requirement. And then you're into the phases of the kind of functional phases of actually agreeing the terms of the deal with the lead investor. Investors will have appraised your opportunity beforehand. We'll talk a bit more about that, but then they go into quite formal, the kind of financial and legal due diligence, where they're kind of really kind of drilling down on the particular points of detail of the company's history to date, and how you have built the plan for going forward, and then actually executing through the legal process. But the one bit I wanted to really focus on about was this kind of socialising your opportunity, and just a couple of points to think about here for founders at this point in the cycle of building businesses. Is this don't wait till you're fundraising to build relationships, and those relationships are a pipeline. And I think it's how you go out and you then find through those relationships, it's where you find the right partners for you relative to all those things that's talked about in the first section. And it's a bit of a repetition of the other point, is that you're not just, it's not a product interaction, it's a partnership, and you are, as I say, it's in a sense you're selling yourself as a founder and your team as an opportunity for partnering and engaging and building something together that you'll build value in together. And as a result, don't see it. the ecosystems, particularly in the Northwest, are really fantastically and rapidly improving versus where the regional ecosystems were 5 years ago, where there was lots of people who were supporting founders to create great looking decks and great propositions, and then it was a kind of blanket just batter them out into the market, and it was an exercise of, you know, you'd gone through an accelerator program, and you'd gone through some support mechanisms to help you build a deck, and then it's about distributing that deck as widely and hoping that someone bites. We think the smart founders and the smart entrepreneurs come at it through this relationship building process, and we are keen, and we really like seeing opportunities. And lots of what we see, if we see 15 to 1800 a year, and we actually only execute on 20 of them or so, 20 to 30 maybe so far as a run rate. I don't know exactly what the figures are, but you know, there's something like 20%, 20-30% we are tracking. So having seen it at this stage, and it's come through to us through our platform, we're actively tracking that. So we are engaging with those founders quarterly or so to say, I know we said we didn't think we were your right partner for your seed stage, but really like to know how you're going on, how's things progressing, how's it going. We're active in our, and again, our technology platform building helps us do that and do that quite efficiently. And indeed, again, that's about building this relationship. So hopefully you also as a founder will start to see investors come back and engage with you in that kind of pre-marketing phase, for want of a better term. So really, it's not just about creating a deck and firing it out to as many places as you can through networks. It's and that's not to say investment. People raise money that way. It happens. Sometimes they get some great deals happen and great relationships are built. But the kind of more targeted, structured process is one that we think will ultimately help you find the better investment partnership to support your growth. It's about pre-qualifying. So, like we said, it's not just about bashing a deck out. It's not, but you do, you have to engage, and you'll need some collateral and some material in which to engage investors and look to get their, having actually demonstrate and capture their interest, that you could be something of a nature that could be aligned to the types of strategy and thesis that they have. What we're really keen to see is make your deck reflective of and authentic to your long-term vision. So again, start with whatever you want to build as whatever as a founder you want to build over the long term, whatever that long term means for you. That should be the cornerstone in everything that you do. Actually, in everything that you do, and particularly in engaging with investors. So be authentic to that long-term vision. Start with, or make sure that it's very clear when you go to engage investors via deck and in pitches and in conversations, that you are representing that long-term vision and where you want to get to, because that's all about building this alignment. Things that we tend to look for in a deck, in our kind of first level of review, and I think we are not different from any investor in this. I think all investors look at it in this way, is to understand, excuse me, the opportunity that you as a founder are trying to address, the pain, the problem, the challenge that you see in the market, and what you're trying to do about it, and give a sense of the scale and the size of that opportunity, and why the timing's right to go and do that particular thing. So why, again, when we're looking at large scaling opportunities, it's understanding why, from a timing perspective, this is an opportunity, a challenge, or a problem, or a product that will really be ready to scale large in 2 to 3 to 4 years from now, depending on the type of model. Deep technology models may be longer. If you're addressing something that actually you need the opportunities right now, and you're trying to go to market right now, it's probably too late. So it's understanding, it's that old, everyone will have heard that Wayne Gretzky quote about, skating to where the puck's going to be rather than where it is now. It's that kind of timing to market. Why are you taking a run to market that will see you be capable of deploying at scale when there'll be inflection points, either because of what you've done or because of what's happening at a macro level in the market, that there'll be a market demand ready to adopt you at scale and ready to engage with you at scale. So it's understanding why you're a big opportunity, whatever that might mean in your context, and why the timing's right, why you see that you building what you're going to build over the next X period will have you timing to an interesting level of demand at that point in time. And why you're the right team to do it, why you guys, why you're passionate, and why you as a founder, and investors, something that's not really come out strongly in this deck, but a point I wanted to make was investors invest in teams rather than single founders. That's not entirely exclusively right, but you know, a proposition is de-risked by a team, the power of 3 and 4 and whatever it might be, but really understanding why the founder and or co-founders who are in place or going to be in place are the right people to do this, why you are recognizing the gaps in your team and recognizing actually it might be that we're looking for an investor who can support some of that skills or experience gap that we have, and also why you are going to attract, as a team, you'll attract the next cohort and the cohort after that and after that of really smart people to help you build this business. What about you guys as a team and the business, the company that you're building? Why will you be able to then attract the really great people who are going to help you realize this vision that you have as the originating founder? So yeah, it's about building that team plan, understanding how you represent, how you will get to the market, understanding the point where to start, the funding roadmap. By that I mean you have got a sense of what resources it's going to need to take to get to the vision that you want to realize, and then how your product develops over that journey. But all sounds like a lot, and it is quite a lot, but what's really important too is keeping it sharp and snappy and concise. So start with the vision, work back to the phase that you're addressing now, and make sure that you'll stand out in investors' minds and memories amongst the other 100 or 1,000 or 2,000 decks that they're going to see in that year. So if something last week I saw was presented with an initial application, a pitch that was over 40 slides long, and there must have been about 300 words on every slide. It was really painful, and I just couldn't get to the end. I think I did eventually, and we review in small groups. There was 2 other colleagues, and that's a real challenge. So really do think about, again, this is a marketing and sale. You're also in a funnel. Think about being short and sharp and snappy and concise. Because if the value proposition can't be expressed in that kind of way, it's question how you go and take it to a customer as well. Another point you need to think about when you're engaging investors is finding investors who can support you on the funding journey. So not just the product development journey or the business growth journey, but actually fundamental to that is understanding and you having a sense of what the funding journey looks like. And so you need to be able to articulate to them what this round of investment looks like, but why it helps you get to the next one, or whatever the next point might be. And that's about what milestones you can build and achieve with this level of funding that you're looking to raise, and what does that next level of funding look like? Because as an investor, you're thinking, well, how do I make sure that at the end of this journey, I've got the type of level of equity that I would like to have in this business with the resources that I as an investor have. So understanding, and ultimately it's only the founder who has this view at that point in the process, what the next, particularly the next round of investment looks like, and perhaps even what you profiling, what you think you might need to raise for in the life of this company to achieve the big vision that you have and want to realize. And then thinking about these milestones that are in between. So really being at that point quite granular. You need to be quite granular to know that, if I want to raise X now, then that's to get me to, and I'll need to raise 5X in 18 months' time. You need to know what you need to demonstrate by way of achievement in that period to be able to go and raise that 5X. That might, depending on the model, it's users, or it might be technology development, it might be a level of revenue. it's not necessarily market traction in whatever that means, revenue or users, but it's showing that you have built you have built value between here and here, and that value is represented by a set of milestones that you yourself have been able to track and measure. Often, again, I didn't want to make this session today. It's not a session to kind of give you a kind of model of what a financial set of projections need to look like, but more about kind of conceptually what you need to be doing in that. And when because inevitably you will be asked by investors, what does the financial future of this company look like as you see it right now, founders. I think what's really key in doing that is one that you create a realistic model one that represents your journey. How often we see financial models or projections that don't quite marry up to the story that we're being told. We want to be raising, we're raising now, we want to raise, £5 million in 24 months' time, and we'll have, and we'll have X number of users and X number of employees, and then we're presented with a financial model that doesn't have any of that in it, that says doesn't have any future fundraising, or says they're raising 3 in 18 months and they'll have more. So you need to make sure that everything marries up, but make it realistic, and also make it authentic to the journey, to the vision that you want to build. I think what we see is the really key fundamental building block of a financial model, particularly when you're a very early stage company, is a financial model inevitably is a kind of set of finger in the air assumptions, and it's building it up on it can be, if it's built in that kind of top down way, quite the value of what a financial model is quite challenging to see. We try to look at it from another perspective, and we think it's really important that founders understand the kind of the core building block of the economic model of the business that they're building. Sometimes called the unit economics, or the unit of value of your model. But by that we mean, what is the kind of smallest measurable unit that your business model, through which your business model delivers value to your end customers, or that your service provides to end customers. What is that? So for a SaaS business, it's subscriptions. For Twitter, it's click-throughs to adverts. For a matching platform, it's the matches that are created through people seeking a particular service and people providing a service on that platform. Think about that and then that's what's demonstrably how that scales that particular unit of value, and build the model from the bottom up, and you can then build it around certain known parameters, rather than take a very kind of finger in the air assumptive set of projections and build kind of top down, because actually if you'll end up in the market and nothing will work that way. But if you're anchoring it from a unit of value or a unit of economics that you know and understand, you can actually build from that. What we're really keen to see too is when you're engaging with investors, that this part make it the start, that again, enlightened investors who want to go on long journeys, recognize that this is a reciprocal process, that this value needs to be being built for the founders. Founders need to have the decent and appropriately substantive shares of the equity of the company all through the life of the company. That's diminishing over time. And please don't take these as kind of representative of what we think. We're just trying to demonstrate the point that while over time you might, the founder who starts off with 100%, or the group of founders who start off with 100% of the equity at the very start of a business, some of that, they sell some of that equity along the way to investors. You need to make sure that you have an appropriate amount of equity at the end. And indeed, if you're working with investors who aren't aligned to that view as well, I think you need to start questioning about whether these are the right partners to be on your journey. I think it's a real challenge, and I think all levels of investors are getting better about making sure there's the right mechanisms in place to ensure that the founding team and the employees in a company, through options pools and other mechanics, are appropriately represented in the share cap table of companies along the whole journey. historically, I think some investors haven't been great at that, and there are sad stories about founders who have very little equity, actually all too early in this process. So I think it's something, again, as a founder, you need to be thinking about the end of the arc of the company's life cycle. I think it's very easy to be quite short term and say, well, and get to a point where capital needs to be raised and doing deals, and sometimes necessity is such that you have to do something that isn't the ideal or optimal position to take. But think be very aware, and founders are and should be. But it's something, again, as founders, you shouldn't feel in any way constrained from really standing up and having an open, frank conversation with investors about, because if they don't align to that kind of view, again, query if they're the right type of investors to be on your journey. And just to finish, wanted to think about some kind of practical points that you need to be kind of flag to you, the questions, and the topics that you'll need to be able to answer when engaging with investors. We've talked about unit of economics, so we see that very much as the fundamental building block of how you build the financial value in a business. You understand what you're selling and who you're selling it to. You can start to then build a scaling model around that. You can then start to identify the milestones and the KPIs and the metrics that would represent scaling relative to that unit of value. If you kind of start up at this other end, it becomes a much more amorphous and variable exercise. Notwithstanding having said that, you also need to, this point, any investor has a view of the type of outcome that they want to get from the type of investment that they're making. That type of outcome tends to be correlated to the size of market opportunity that a proposition has. So be able to really understand, and you as a founder, you also want to know that actually expending all this blood, sweat and tears over a number of years and living this crazy life that founders do, that actually you're doing it for something that's for a prize that's big enough that it's worth getting onto that really tough journey. Often super rewarding, super exciting, but super scary and super tough journey. But make sure you understand that what you're doing, you're addressing a big enough problem or a big enough opportunity, and understand the characteristics of that market as well. Understand the dynamics in that market. If you don't understand how that supply chain works and where your customer exists in that segmented supply chain, or understand how the financing of buying what you're selling works. So it's really investors will quite quickly get into wanting to interrogate your understanding of your target market in terms of sizing and how that market's shaped up and characterized, and how it acts now and how it might develop in the future. Because that's really the most important thing. Actually, what the market looks like now, and how it shapes and characterizes now is one thing. But what's really interesting and important from an investor's perspective, and you as the founder, is how do we think it could look like in 5 to 10 or 15 years when you are in this scaling and trying to get to this optimal growth position. The other obvious things to know about and understand is who are your competitors, but ultimately why is your proposition for the market better, stronger, quicker, faster, or what's the value? How's your value proposition kind of differentiated and ultimately defensible as well? How do you ensure that or have a view on how you create defensibility around your proposition against, and there will be, and very few, a minute proportion of propositions really have no competition or next to no competition. Most people have something. If not, it's the status quo. It's trying to displace what's currently done to address the challenge. So really think about that and understand that, and understand how you create defensibility around that, whether that's through the smarts and the technology, or through being able to acquire a big moat of very sticky users very, very quickly that creates defensibility around others trying to compete with you. And just to finish off, why again, I think we've covered this already, why are you the right people, and why will others join you on the journey? Because ultimately you're going to have to be able to, and that's very, very important actually. as we now experience and understand, you know, being able to attract the right talent and retain and incent the right talent is around what you're doing. And quite often that's not necessarily around, you know, motivating them through paying them lots of money or giving them equity in the business. It's around you addressing an interesting challenge that great AI developers or data scientists or whatever it might be want to come and actually address and get and be part of finding a solution for. So think about how you'll build up your team and why you'll be able to build up a team. We've talked a bit about, next point, you know, what's the proposition, but not just now, but how do you generate stickiness, whatever that means for your product? How can you develop that? And then, you know, lastly, you know, investors will come and ask you that point. What does the future look like for you, founder? What's your end goal here, and how do you think you get there? And so just to close on the point we opened with, really understand your journey that you want to go on, and the kind of the main staging points in that journey, because actually ultimately you should drive at all times through the lifestyle of the business. Really should be. It's not, in the sad scenarios, it's not always, but really it should be. If it's working well and it's working healthily and optimally, we are still driving towards the founder's vision, or the founder. It'll be an evolved vision over time, but it's the founder who's leading that business rather than other stakeholders within that business. So be very assured of what the future looks like for you and your company.